Bonds play a crucial role in the economy and your portfolio. They help build businesses and finance governments while giving you a steady stream of income. But what exactly are bonds? Imagine that I ask you for $1,000 with a promise to pay you back later. You probably wouldn't want to give it to me, because giving it to me means losing out on the interest you could have gotten from leaving it in the bank. But I need the money, so to make you want to give it to me, I write up a contract. The contract says, on this date a year from now, I will pay you $1,000. Plus every month I'll pay you $10 to make it worth it to you. And I ask if you want to buy this contract for $1,000. What I just offered you is essentially a bond. A bond is a contract issued by an entity that wants to borrow money. In exchange for the borrowed amount, the entity often gives the bondholder interest payments called coupons, plus an amount of money on maturity, often called the face value. There are three main ways a bond differs from a loan. 1. A bond is a security that can be sold by the bondholder. Imagine that you decided to purchase my bond for $1,000, and half a year into it you realize that you needed the money right now. With a bond, you do not have to wait until maturity date. You can sell it to someone else, giving them the remaining interest payments plus the face value on maturity. 2. Bonds are securities with strict legal structures. Unlike loans, where every condition can be negotiated and changed from loan to loan, a bond follows standardized terms and market convention, like a fixed maturity date and interest payments. 3. Bonds are issued to the public. Unlike traditional loans, which are typically obtained from banks, a bond can be bought by anyone with enough funds. This means that the bond issuer has access to way more potential capital and doesn't have to rely on banks on proving their loans on their terms. There are many types of bonds: treasury bonds, corporate bonds, municipal bonds. The list really never ends. The types of bonds differ on length, payment frequency, and issuer, sometimes other features. Treasury bonds are long-term bonds issued by the US government with a maturity date of 20 to 30 years. They pay semi-annual interest until maturity, at which the face value of the bond is paid out. Treasury bonds are usually considered a safe investment because the US has a stable economy with a long history of fulfilling debt obligations. Corporate bonds are bonds issued by companies looking to grow their business, pay bills, or something along those lines. Corporate bonds differ a lot on length and payment frequency, and the risk when investing depends on the future prospects of the company. And there's a trade-off here. Usually the riskier an investment is, the more yield it will pay. AAA rated bonds usually pay low yield, while junks usually pay high yields. If an issuer defaults on your bond, you might lose as much as all your remaining payments. However, often in the case of a default, the issuer will restructure the bond or pay them partially. If a company goes bankrupt, the bondholders are considered creditors and will be paid out partially through the liquidation of company assets. And if a government defaults, it has often been in the past that they restructure the bonds in order to handle the payments. In 2015, Greece defaulted on their debt obligations, and bondholders lost as much as 50% of the value of their bonds. And in 2001, Argentina defaulted on over 100 billion in sovereign debt. Investors in this case got 30 to 35 cents on the dollar, losing 70% of the value of their bonds. Thank you for watching this video until the end. Please leave a like and subscribe if you want more, and leave a comment down below telling me what other topics you want covered.